I'm going to share with you, first of all, my own story of when I started my journey with Progressive, and when I was sat somewhere over there, which was about 6 years ago, and I'll share with you how I got there. And then if we've got time, we'll talk about tax. Does anybody have any tax questions, by the way? So nobody has any questions on tax, bar one person who was very kind to allow me to take the water before she did. So should we answer your question now or later? You have a preference? No, you can choose. Now, and your name is?
My name is Dahlia.
Hi, Dahlia.
Can you possibly summarise the benefits of, I'm doing a remortgage at the moment, whether I should do it in a limited company or in my personal name and going forward to my purchases? Which way I should do it?
How long do you have? We need, yeah, that's my favourite answer. Yeah, you obviously know me too well because you've heard me many times. It does depend, in fact. So that question is very wide in scope. Let's narrow it down. So is the situation that right now you have a job somewhere and property? No?
No, self-employed.
Okay, so you're self-employed, working for yourself, doing property or something else and property?
Property and e-commerce.
Property and e-commerce. And does that take you into the higher rate of tax? So are you...
Probably it will hit this year, yes. At the moment, no, but I'm close to it.
So I'm generalizing now because it's difficult to answer that question. So if it's going to take you into the higher rate of tax, right now as things stand, you're better off having property in a company because Section 24 then won't affect you. Yeah, but if you own the property in your own name and you're looking to refinance it, and then you want to refinance it into a company, then you've got capital gains tax and stamp duty land tax to think about. So you said you're looking to remortgage a property. Is that one property or a number of properties?
Start with one, roughly.
So you own that property right now. And how long have you had it for?
20 years.
And is there a big gain on it?
Yeah, huge.
So the problem you've got is if you move that into a limited company, you'll have to pay capital gains tax and possibly stamp duty land tax. And looking at those figures, it might not be worth you doing that. Going forward, you can buy future properties in a limited company, possibly, depending on your self-employed business, reduce your income from that if you can do, okay? So you'd stay well below the higher rate of tax, and then Section 24 won't affect you for that one property. Does that help?
Yeah.
Any other questions on that? Cool. Anybody else have any questions on tax? You're good. Your name is?
I'm Ross.
Hi, Ross.
Do you have any advice about enterprise investment scheme to kick capital gains down the road?
It's if you have a capital gain and if you can find a company which you believe in and you think it's going to do well, because the whole point of the enterprise investment scheme is it's high risk. So you could invest your money in it and at the end of 5 years have nothing left over. But if you can find a good company which has qualified for EIS, invest in it, very good for capital gains tax and income tax. Yep. So I'm a big fan of those schemes. But you've got to find the right one.
If the company fails, are you still liable for the CGT then?
As long as you keep your money in there for 5 years, no. Yep. And you get, and if it fails, you also can reduce some of your income tax as well. But you don't have to invest all your money in one company. So what you can do is find 5 or 10 or 15, diversify, spread the risk. So if 1, 2 or 3 fail, 1, 2 or 3 may do well, and the other 6 to 9 may do nothing. So I'd say, depending on how much you've got, spread it over a number of companies. Yep. But you've got to do that within 1 year of having made that capital gain. Yep. Did you have a question, my friend?
Maybe it would be helpful to everyone if you could go through the methods of getting an existing personal portfolio into a company without all the paying taxes and everything, the rough costs of it.
So incorporation.
Still haven't got around to it myself.
Okay, anybody else have any questions on tax? Yes, sir. Your name is?
Jeff.
Hi, Jeff.
Thank you.
Was that enough for you? Did you feel the love, Jeff? Did you feel the love? No is the answer. Your name is?
Jeff.
Hi, Jeff.
Thank you. I'd like to add LLP to your question, and it might also be a stepping stone, James, in your incorporation. I've heard LLP can be a route, but what if you buy it in an LLP in the first place? Are there advantages, disadvantages?
Okay, we'll try and cover that as well for you.
Thank you.
Is that a hand at the back, or are you having a good old stretch? You're having a stretch, cool. Anybody else over there? Hi, your name is? Hi, Steve.
I just want to know, when you start now, do you register for VAT?
Okay. Peter, we're doing well here. We've got limited companies, LLP, VAT, we'll have SDLT, corporation tax, inheritance tax, fuel duty, business rates, council tax.
Shall we do this first?
Yeah.
Or should we do this?
Maybe you should do a course.
It's never going to get to
Maybe I should do a course, you're right, that's a good idea. Why did I not think of that? Anyone else? No? Okay, we're going to park these three up, and Peter, you're going to do me a huge favour, but because I've been told I need to finish by 5:30, so we've got 45 minutes. If I spend 20 minutes boring them first, so they fall asleep, that means I can finish early, Peter, yeah? So in about 15 minutes, you can remind me, or 20 minutes to stop, and then with this we'll cover in 20 minutes, but no doubt you'll have some questions. But share my own experiences with you. I need to remind myself where I started. I decided to buy my first property, which was this piece of land here in Mavis Enderby, which was 11.8 acres. At that time, I'd saved up a reasonable amount of money. So I bought this piece of land for £140,000. And being a smart ass, I thought I would use some of that cash to buy the piece of land. So, number one, if you don't take anything else away from this particular talk, take away the fact, just because you've got money in the bank and it may be burning a hole in your pocket, do not invest or spend it unless you know it's a good deal. People make that mistake quite often, and I did too. So I bought the piece of land, and I was told I can get planning for 6 5-bedroom houses with triple garages in a small village. Now, I'd never been to Mavis Enderby. I've got no idea where it is. For your benefit, it's near Spilsby, which is near Mablethorpe, which is somewhere in East Lindsey District Council. Okay, which is far away from Peterborough, very far away from Peterborough. No idea where that is. Okay, I bought the piece of land, we applied for planning, I was referred to a planning consultant local to this particular area, former chairman of the planning committee. That made sense, so I thought this guy knows what he's talking about. Paid him about £10,000-12,000. The application goes in, and then we see about 64 objections on the planning portal. So I decided to go and visit the place. And I established there's only about 12 people who live in that bloody village. So where the other 52 odd objections came from, I have no idea. Anyhow, long story short, the planning doesn't go through. I then sacked that planning consultant, because it's always other people's fault, isn't it? It can't be our fault. He's crap. So I find somebody else in London, a planning barrister, and he comes up with a good idea to apply for 14 3-bedroom houses. So we do that. Lo and behold, when the planning application goes in, apparently they've changed part of the local plan, so this particular piece of land is not part of the local plan. So that planning application fails. Okay, by now, in case you're wondering, Andrew, I'm about 250 grand light, all right? You don't want to know what I said to my wife, by the way, you don't. And this particular planning consultant's pretty sharp though, so he was really good. He came up with the idea. He said, the planning department have said you can't build homes or houses on this piece of land, but because it's in an isolated location. So he said what that means is it qualifies for paragraph 79. Has anybody come across paragraph 79? So paragraph 79 basically is houses that are built in an isolated location, the kind of stuff you see on grand designs. So we then employed an architect who specializes in paragraph 79, applied for planning, and the planning department in East Lindsey wanted us to go to something called the Design Council. So here you've got 3 folk basically who know a lot about design, know a lot about planning, and know a lot about landscaping, that type of stuff, okay? So we're sat there talking about stuff, and I'm sharing with them why this house is perfect and why this house would be a perfect family home for me. And from the 3 people, 1 was a woman, 2 were male. The woman who was clearly the smart one, and she said, Mr. Nawaz, the house is perfect, because it has to be an exceptional design for the Design Council to pass it through. But I only have one concern. You said you've got children. The landscaping doesn't work for your children. So unfortunately, on that basis, we can't approve this particular plan. By the way, that cost me 12 grand to have that meeting. Okay, so we go back, change the landscape, go back to them again. They still don't like it. Long story short, by this time, even the head of planning at East Lindsey is a bit peed off. And he says, I think they're being a bit unfair. We're going to give you planning for this particular house. So now I've got planning for a house in East Lindsey, which is costing me about £350,000 to build this super duper home. So I've got 2 choices now. I can either sell it or I can build it. If I build it, it costs me 750 grand. If I sell it, I've got to find a buyer. Nobody wants to buy it, by the way. So that was my first mistake on 350 grand. Around about 6 months in from having done this, I met a farmer from Grantham. She's got 12.2 acres of land. She's got no cash, which is generally the scenario with farmers. Asset rich, cash poor, a bit like property investors. And at least somebody appreciated that, didn't they? So I entered into an option agreement to apply for planning. And the farmer was quite keen to use Savills. So the Savills office based in Leeds. So we appointed them to go through the planning application, and they said we could apply for planning for 125 houses. So I thought, good, I'm going to make all the money back on Mavis Enderby plus Grantham, okay? So by this time next year, I'm made. So I've now spent 150 grand with Savills because they don't come cheap. The planning application goes in, the planning officer doesn't like it, 125 houses become 100 houses, 100 become 75. Then there's this big, massive case going through South Kesteven District Council, I think is where Grantham's part of. So they say, wait for that case. We wait 2 years. That particular case doesn't go through. The planning falls through. So then Savills thinks it's a good idea. We should go to the planning inspectorate. We go to the planning inspectorate. That cost me 50 grand. So gave another 50 grand to them. That didn't go through either. So now I've got 11.8 acres in Mavis Enderby. I own part of 12.2 acres in Grantham. I'm thinking, this whole thing's a bad idea. Okay, so I'm about there. So I think let's go small, Shaz. Big is not good. Big doesn't work. Let's go small. So St. Paul's Road is in Peterborough. It's about 3 miles from here, 4 miles from here. We find a piece of land. It belongs to the local council. It's going to auction through a local agent. I talked to the agent, and the agent said you can have this piece of land for £97,000. So I had a joint venture partner, and he was keen to go to auction. So I said, okay, fine. Take it to auction, but whatever you do, don't pay more than 97 grand, because we can buy that for 97 grand now. He goes to auction, does the whole thing, rings me up in the evening. Shaz, good news, we've secured the land. Fantastic. How much did we pay for it? 117 grand. Yeah, Pillock, what happened to you? And his answer was, I got excited. So he got excited, and it cost me 10 grand extra. That's not a good place to be. Anyhow, long story short, we did that. We applied for planning for 5 2-bedroom apartments. that planning went through, and I've still got this particular development. I've bought him out, okay? But we made probably 120 grand uplift on that, all right? So that wasn't too bad. From there, I ended up back in Boston, bought this property, empty for 13 years, a whole lot of tax savings there, which I might talk about some other time. Bought it for £375,000. By this time, remember, I've got no cash left because I've got best part of 350 grand stuck here, 200 grand stuck here. So I come across this particular concept, which I did not believe in, called no money down. So other people's money, and I do the deals. So I thought, this is a lot of, but let's give it a go. So I found someone who had some cash, all right? And while talking to them, okay, I've got a very bad memory. I forgot to tell them about these two deals. I totally forgot. But I told them about this particular deal here. I said, I've made it work. I'm experienced. I know what I'm talking about. You won't be giving your money. I'm an accountant. I'd never lie to you. Long story short, he believed me, and he paid £375,000, £395 to buy this particular project development. We then needed £474,000, I think it was, to refurbish it, which we did. So long story short, let's call it cost us 900 grand. End value for this was 2.1 million. Okay, none of my money. So this worked pretty well. So I've got 100 odd grand here, 1.2 million shared between two here. Same person here that we bought this particular property in Peterborough for £500,000. Obtained planning for 12 flats, 6 one-bedroom, 6 two-bedroom, and we made an uplift of, I think it's about 550 grand, but we call it 500 grand. And this finished Feb 2020 last year. This one here, we finished in Feb 2021, so about 3 or 4 months ago. This was refinanced with Interbay, and this is being refinanced through Aldermore. Same guy again. I found a piece of land in Boston. I seem to like Boston for some reason. Found a piece of land in Boston on sale for £395,000. Did a deal for £350,000 just before COVID. But we established that the planning was about to expire in about 2 months' time. So they had outline planning, and you have to apply for detailed planning within a certain time frame. It's about to expire, so I go back to the seller and say, there's no way I can put the reserved matters application in within 2 months, so therefore I can't pay you 350 grand, but I'll pay you 315 grand if you're interested. And they said, fine, pay us 315. So paid them 315 using the money from the same guy. Then it cost us 75,000 to go through reserved matters. So it's cost us best part of 400 grand or thereabouts. We've got planning for 40 houses. So the uplift on that was about 450 grand. And we're just about to start building on that. And 100% of the build cost is funded by a particular lender. At the same time, so we're going to make £1.6 million on that. At least that's what the spreadsheet says, by the way, okay? How much we make, I'll share with you probably in about, I'll share with you in about 12 months' time, but that's what the spreadsheet says. And spreadsheets never lie, do they? No. God, no. Same time, Bicker 2, there's a piece of land next door to it. And by the way, we did an option agreement with no deposit, nothing, so we pay the full funds once we get full planning. Now, once you've got outline planning, you're going to get detailed planning, but I was keen not to tie up any funds whatsoever. Same thing again, we do in Bicker for 9 houses, paid 270 grand, reserved matters is in, that probably go through in about 3 or 4 months' time. So once we build the 40 houses, we're going to build the 9 houses next door. Then the same thing again in Butterwick, which is probably about 3 miles from Bicker. We're buying it for 470 grand, I think, planning for 26 houses, and the uplift on that is about 850 grand, and that's just about to go through. And then we bought the main post office in Boston. Again, same premise as these ones here, and the uplift on that is going to be quite big. It's about 1.2 million because we're going to apply for planning for change of use, plus it's got some land on the side, so we'll have an extra, I think, 8 to 10 flats. So I started off using my own money, and as things have progressed, I'm now using other people's money, and that seems to work better for me. So if you've learned nothing else, just remember, don't use your own money. Don't use your own money. Use somebody else's money, okay? That seems to work better. No, I seriously, I think I'm more focused, because I'm using somebody else's money, I'm more conscious and aware that I've got to make the deal work. I think that works better for me. When I'm using my own money, I think I'm too relaxed about it. And that's why the first two the top ones worked okay, by the way, because even if I build it myself on a serious note, I'll probably make about 300 grand. Which probably isn't, well, it isn't as good as some of these deals here, but that's where I started. And sometimes, I don't know all of your backgrounds and your history, but sometimes, especially in property and in business, everybody has to pay their entry fee, okay? I call it your entry tax. And that is the mistake or a number of mistakes you make in order to become sharper. We all have to pay that, guys and girls, okay? So I think here I've survived. This might be my entry fee where I lose about 200 grand. But in the whole scheme of things, if I lose 200 grand here, with everything I've made here and some, it ain't too bad. So if I can do all this stuff here, the point of sharing the story with you is not to talk about my deals. The point is, if I can do all this stuff here, I assure you, no matter what your background and experience, knowing me as I do, and you don't, but knowing me as I do, I can assure you, you can all do much better than that. The only one thing you have to do, which you already know, is you gotta do stuff, you gotta take action, okay? If you take action, I assure you, you'll do these deals and much, much better. Quite often what I find is we all come up with too many questions, objections, hurdles in our mind about how we're not good enough, or how things are going to go wrong. But having 5 businesses and having mentored lots of people, and I've done over 3,000 business growth consultations now, I can tell you most of the objections and the hurdles and the questions you come up with in your mind, they're never going to happen, by the way. They're never going to happen. So stop overthinking all that stuff and thinking, well, if what people find out I haven't got the experience, what if I haven't got the money, what if something goes wrong, what if the bank manager dies or whatever else, okay? Most of that stuff doesn't happen. Some of it may do, so you just got to get out of your own way and do stuff, okay? Because success for you guys and girls, I assure you, because I've been there, success for you is just around the corner. You're not far away. You're 2, 3, 4, 5 steps away from really breaking it through and making it, whether you want to do single lets, service accommodation, commercial conversions, new builds, deal sourcing, whatever your strategy or your strategies are, you're not that far away from success, because I was there 5 years ago. And that's the stuff I've done in 5 years, by the way. All right? And you can do that and some. So, my friend, back to you. Incorporation.
It's always.
Any particular question or just general incorporation?
I guess it's for anyone who's got an existing portfolio of properties in personal name, so pre-2016, and what are a few different methods for getting them outside Section 24 with the minimum of paying?
So we'll cover one, which is incorporation, okay? So Mr. and Mrs. Smith Mr. Smith owns 10 properties, which he has done for a number of years. He has a wife, could be a husband, but in this particular case he has a wife, Mrs. Smith, who doesn't own the properties. He's a higher rate taxpayer and finds out Section 24 will affect him. He'll have to pay a ton of tax. So his options are stay as he is, give some of the properties to his wife, sell the entire portfolio, okay? Or possibly incorporate. Now, if he moves those properties into a limited company, his main challenge is he'll have to pay capital gains tax. But then you've got Section 162 incorporation relief, which if he qualifies for it, he won't have to pay capital gains tax. So if you can demonstrate you have a business, okay, not a trading business. Generally speaking, owning property, holding on to it is an investment business, and most tax reliefs are available to you if you have a trading business. However, for Section 162 purposes, the way that the rules are written, it doesn't use the word trading business, they use the word a business, and property is a business. So as long as you can demonstrate you have a business, and there's there's two cases that have gone to tribunal, but the popular one is the Elizabeth Moyne Ramsey. Okay, so you can have a look at that online. Okay, just type in the incorporation Ramsey case and you can read about it. If you meet the rules for incorporation, Mr. Smith can incorporate and he won't have to pay capital gains tax. The problem for him is he'll have to pay stamp duty, land tax, and that could be quite significant. So an option for him is if he genuinely gives some of the properties or a share of all of the properties to his wife without any intention of incorporating right now or in the near future, and his wife has a share in the properties, they run that business as a partnership or an LLP for a number of years, let's say 3 years, with no intention of incorporating, and in say 3 years' time they then wish to incorporate. Because they're a partnership, they possibly won't have to pay SDLT unless the rules change. Yeah? When they incorporate, they'll have to refinance, and there is an opinion out there that you don't have to refinance. I think it's best to refinance. It's just simpler, straightforward. You can just, rather than doing a deed of trust. But if you did do a deed of trust, that works too. But I just think refinance, there's a whole lot there. And you don't get any cash back. You get shares in return for your equity in the properties. And then everything's stuck in the company. No Section 24. But if you're taking money out, you may have to pay income tax depending on how much you take out. So you can take a salary and use your personal allowance. Then you can take an additional £2,000 for your dividend, and then any additional dividends you pay tax.
Any disadvantages to incorporation, or would you incorporate if you had a bunch of personal property at the moment, or would you?
I think if you're a high rate taxpayer, it makes a lot of sense to do that, because the Section 24 charge is going to be quite high. If you can avoid the capital gains tax liability, if you can avoid the stamp duty, land tax liability, it's well worth doing.
But that's only if you've got mortgages to pay, so you'll be paying tax on the interest.
Well, if you haven't got mortgages to pay, why do you want to incorporate? Just to stay as you are, okay? Unless you're paying a lot of tax and you're thinking, well, I want to incorporate because all the profits I make from my property are then recycled into buying more property, so why pay 40 or 45% tax when I can pay 19% corporation tax and use 81% of the funds to reinvest in further property? Unless that's the reason, you don't want to incorporate because Section 24 is not affecting you. In line with the question over here, yeah? Any questions on that? No? We have. Your good name is?
Adam.
Hi, Adam.
So, in your scenario, when you move from private ownership into LLP, does ownership actually change? So obviously when you incorporate, the ownership of the property goes to the corporation, doesn't it? So when you go to LLP, does ownership from individuals actually change?
It doesn't have to, because in an LLP, you can own, say, 90% of the company. I can own 10%. And then when you introduce the properties to the LLP, they're sat on your capital account, so you've got ownership of them, but I've got a right to any of the income, okay?
I'm thinking of prior mortgages. So if I've had a buy-to-let mortgage in my personal name, and then I put it into an LLP, sometimes they get a bit...
It depends on the terms and conditions. If the terms and conditions say if there's a change in legal or beneficial ownership, you have to let us know, then they will get twitchy. If that's not in the terms and conditions, then you don't have to inform them, but it is good practice to do so. If you do so, by the way, they will say to you, you need to refinance. Yeah. Yeah, no worries. Any other question on that? No? Cool. Okay. LLP, whose question was this? Okay. And the question was?
Yeah, well, you've probably actually already covered it because I had heard about an LLP as a potential stepping stone to incorporation.
Without you having predetermined that it's a stepping stone.
Yes, but that's noted.
Yep.
Of course, we have no idea. That's why I mentioned it.
That's right. You're just talking about LLP here. That's good.
Okay, but then what we found is the rates that you tend to get for finance tend to be higher in a limited company, and I'm sort of assuming LLP. So the net effect may not be quite as good as you might think it would be.
You're right, because on a limited company. Hi, Mark.
Hello.
You're right. For a limited company, I mean, the deal in Boston we're with Interbay, it's 4.74 fixed for 5 years, which is higher than what we would pay in our own names.
Yeah.
The one for New England Club is with Aldermore, which we're going to complete on Friday in 2 days' time. I think that's 4.24 fixed for 5 years. So yes, you're right.
The arrangement fees may also be higher as well. So
1% arrangement fee, but you can negotiate that depending on the size of the deal.
Sure.
Yeah. So arrangement fee is going to be similar, but the interest rate will be higher. Yeah. So you just need to do that calculation to make sure it works.
Okay. But nobody really talks about LLP as a vehicle. It's either personal or limited. Is there any advantage for LLP in place of limited, or is it just as a stepping stone, even though you have no intention of doing incorporation?
So an LLP is a good beast. It's very flexible because you've got a capital share ratio, which is I'll cover that very briefly with you. Then you've got a profit share ratio. So simply speaking, if you have a limited company and you own 80% of the shares, I own 20% of the shares, and the ordinary shares, if you take a dividend of say £8,000, I have to take £2,000, okay? Because that's in line with the 80-20. I can do a dividend waiver, starts getting complicated, HMRC don't like it, they might come and have a look, causes problems. If you and I have a partnership or an LLP, and you own 80% and I own 20%, but in one particular year you say, Shaz, I don't really need the cash, and I say to you, I need the cash, I can take 90% of the profits, you take 10%, or you don't take anything, that works okay. So you've got that flexibility, then that flexibility helps when you've got children, then they are ordinary members of an LLP, and so you can give them some of the profits which aren't in line with their profit share ratio. It's easier to run usually compared to a limited company. There's more flexibility. If you're looking at having company cars, if you've got a limited company, you're going to have to pay company car tax. Electric cars are quite tax efficient right now through a limited company, but as time progresses, I think they're going to charge us higher rates. LLP, there's no company car tax because you as partners are the business. Therefore, you only make you include something at the end of the year for personal use. So you say, I drive the car 70% for business use, 30% for personal use, so you only claim 70% of the costs, but there's no company car tax to pay. So those kinds of things are beneficial in an LLP. It's a very flexible arrangement, one that I think you ought to be looking at and using it in your wider property business. Yeah?
And it takes you out of Section 24?
No, it doesn't. Only a limited company does. This is what I'm saying, in your wider property business and looking at the kind of strategy you're using, it can save you, it won't save you tax, but it'll give you a lot of flexibility. Sometimes may save you tax too. The general problem is most accountants don't understand LLPs, so the minute you talk about them, say, no, over here, okay, let's talk about limited company or in your own name, okay? But I think you should all explore this because I've used LLPs on a number of occasions and to good effect. Yeah, so always worth looking at, especially if you're doing commercial conversions or service accommodation. Good strategy. Happy with that?
Yes, thank you.
Any other question on LLPs? Cool. Whose question was VAT over there?
Yeah, so I have a limited company and I keep getting Depending who talks at the day, different advice about whether it should be registered as for VAT, because I'm told that you have to pass the VAT on to if you're renting properties to be registered.
So let's look at your scenario. So you have a company, or are you buying property in your own name?
Limited company.
Limited company. And are you looking to buy single lets or commercial conversions or something else?
Commercial conversion.
Okay. So you're looking to buy a commercial property right now, possibly?
Yes.
Okay. And does the commercial property have an option to tax, i.e. is the seller charging you VAT on the transaction?
No.
Okay. So what's the advice you've had so far?
It's all around claiming from builders, so the VAT they charge, that's where it's come in. So should I be registered so we can start claiming against those costs?
And what's the advice you've had so far from the people you've spoken to?
So I've had one person who's said it would be worthwhile because you're claiming back all of those expenses at the moment, because it's going to be about 400,000 on build costs plus whatever the VAT is.
So 80 grand on that, or if you're doing a commercial conversion, it's going to be 5%, but yeah.
Yeah.
So
but
20 grand.
Have said it's not worth it. By the time you get round to, I'm going to keep the properties and rent them out. It will cause complications.
Okay. And from the advice you had, which view do you prefer?
I like the mixture where I don't have to charge the VAT on top for the rental. So I don't know if there's a rule around that.
Okay, let's try and help you with that first. Do we charge VAT on rentals? No. Is there ever a situation where we charge VAT on residential property?
Not till Rishi thinks of it.
Not until Rishi thinks of it. And I don't think he is, because it's not worth his job, by the way. He'll get fired.
Do you have to charge it if you claim VAT on the building materials?
No. Rental income is an exempt supply for VAT purposes. So my friend, you never charge VAT on residential property. Commercial you do. So let's look at your scenario in the next 7 minutes and 55 seconds. You're about to buy a commercial property and it has an option to tax. How much are we buying the property for?
200.
500 grand, yes, that's a good number. Nice and easy. I like that. And the VAT on 500 grand is £100,000. Okay, so if you're having to pay the VAT, what's the first problem you've got? You've got to find the cash, okay? And if you don't have the cash in your pocket, you go to a bank, so you'll have to pay arrangement fees, you'll have to pay interest, okay? Once you've paid the VAT, what's the first thing an accountant or you may think of doing? Claiming it back. Who are you going to claim it back from? The tax man or woman, but okay, HMRC. Is that an enjoyable thing to do? Do HMRC like giving money out? No is the answer, okay? So you've got pain of finding the money, you've got then pain of trying to get the money back, okay? So that's the first thing. The second thing for you is, if you're buying a property with an option to tax and you're paying VAT on it, you're going to pay stamp duty land tax not on 500 grand, but on 600 grand, yeah? So basically, you're paying tax on tax, yeah? And that's not enjoyable either. So you have two options, and I think Ray was talking about one, which is a VAT 1614D. So the person that you're buying from, you could submit a VAT 1614D. If they accept it, then you don't pay VAT. And you do not have to register for VAT. But you have to make clear your intention that you're looking to convert the property to residential. If the seller does not accept the VAT and does not accept the VAT 1614D form, and they're under no obligation to do so, then you've got an option to avoid paying the VAT, and that is if the property has a sitting tenant who has at least 3 months to go on their lease or will occupy the property for 3 months or longer, then you can use the transfer of going concern rules, okay, TOGC, and you don't have to pay the VAT, which saves you finding the money and claiming it back. But you have to register for VAT, and going forward, you must charge VAT on the commercial rent if you're going to rent it out commercially, and you have to charge VAT when you sell the property. Okay, so VAT 1614D or TOGC or pay the VAT and reclaim it back, yeah? Those are your three options. VAT 1614D is the best. Now you've bought the property and you're looking to convert it. When you convert the property, if you increase the number of dwellings, or you reduce them, or you buy a house which has been empty for 2 years or longer, you only pay 5% VAT on the refurb, yeah? And that's 5% on the labor costs. If you buy the materials yourself, you have to pay 20% VAT. If you outsource labor and material, then you only pay 5%. So it may be worth it to outsource the whole lot, depending on how much you're going to be spending on the materials. Once you've done that, if you intend to sell all the properties, and when you sell properties, do we charge VAT?
No.
Is there ever a situation, apart from commercial property, that when we're selling residential property, we charge VAT? No. So if you're selling properties, or if you're going to sell those units, then you can claim back the VAT. Yeah? And do that as you go along, because it'll give you a cash flow advantage, yeah? If you're going to hold on to the properties, can you claim back the 5% VAT or no? Our friend here says no. Anybody disagree with him?
You don't disagree with him.
You don't agree with him?
You don't disagree with him.
You don't disagree with him? Okay. We never disagree. Okay. So if you're going to keep hold of the properties, generally speaking, you don't claim back the VAT, because if you claim back the VAT, you're not going to charge VAT on the rent, and HMRC will come and say to you, hold a moment, you claimed back VAT, but you're not making VATable supplies, therefore all the VAT you reclaimed, can we have that back? Okay? But there is something you can do, and this is not easy, it's complicated, but if you go to a good accountant or tax advisor, they can help you. You buy the commercial conversion in let's say a limited company, then you set up a second limited company, and this becomes your management company. You grant a lease of longer than 25 years, 21 years, longer than 21 years. So this has to be done properly, guys and girls, but I'm just quickly sharing it with you so you can raise your awareness to it. Grant a lease of longer than 21 years, and when we grant leases, you may have to pay stamp duty. You have to pay stamp duty on leases too. However, if this company owns 75% or more of this company, in this case it's going to be 100% because you own both companies, but if this company owns 75% or more of this company, then you claim group relief, so there's no stamp duty to pay on the lease. So you avoid that. Once you've granted the lease, okay, which is a major interest in land and property, you can then claim back the 5% VAT, and this company then manages all the rentals for you. However, something you need to be aware of, obviously, this company then pays you something, keeps its own funds. The funds it keeps itself, call it commission or call it management fees, call it whatever you like. If they exceed the VAT threshold, this company will have to register for VAT. But that's a long way down the road, because you need to own quite a few properties for this company to exceed the VAT threshold based on charging you, say, 10% fees. Happy with that?
Yeah.
That gets you the VAT back, and you keep the properties, and you charge the rent, and you don't charge, and then there's no VAT issue for you going forward. How's that?
That's great, thank you.
Cool. So we've got 1 minute left, Peter. Can we take one final question if anybody has a question? Does anybody have one final question?
This is your chance before we all disappear.
Motiul, my friend, go for it.
Does it have to be directly belong to that company, or can it be within your holding company? Say if you have your holding company up and create a separate company for the management.
If you have a holding company here,
No, above that.
if you have a holding company here, or here, okay, and then you've got this one here, and it's 100% owned, and this one here is 100% owned, this owns this 100%, that works okay. But to keep it really simple, what I would do is holding company owns 100%, this owns 100% of this, and go 1, 2, 3, keep it simple. But you can have it there as well, by the way, we've done that too. It's still a 75% group for group relief purposes, so you'll be fine. Okay? Thanks for watching, and I hope you enjoyed this video. If you have, by the way, make sure you click like, subscribe and post a comment because that tells me that you're engaging and you're finding the content useful. And if you like this video, make sure you check out this video here because it's the next stage in terms of your learning and development.